I'm going to spend a few minutes today talking about the Trump proposals related to taxation, income taxation, estate taxation, and also our financial services business. And this kind of goes against our normal rule about legislation. Our normal approach is to wait until proposed rules actually become law rather than speculate about how they might turn out. The problem with that for us is that the Trump presidency seems to be a little bit more disruptive, or perhaps substantially more disruptive than any other new administration in my own experience. And so people are asking for details more often now than they have in the past. And so we decided that talking about this might be the right thing to do. In addition to questions from producers, our clients and our prospects have hopes and aspirations and concerns with regard to the new administration, and those ought to be addressed. So if you're equipped with some information that you can use as you talk to them, I think that's good for you and your business, and it gives you an opportunity to better serve your clients. I guess one thing that I'd really like you to take away from today is that the details of what we talk about are almost certainly going to change. We'll talk about some detail. There isn't a lot of detail with regard to some of this stuff, but we'll talk about some detail and recognize that detail may change. Now we're going to talk about three areas briefly of Trump proposals. First, income tax changes. Secondly, estate tax changes. And then the third thing is all of us are in our business are a little bit fixated on the Department of Labor fiduciary rules. We'll talk about that. We won't talk in a great deal of depth. In some cases, the depth doesn't exist at all. But we'll highlight how you might use the information to help your clients and prospects. So let's go ahead and get started and take a few minutes on this. Let's talk about first the income tax changes. What are the income tax changes that are being proposed by the Trump administration? The first thing is that personal income tax brackets could very well change. Under our current rules, personal ordinary income tax rates have 7 brackets, which max out at 39.6%. Those of you who are perhaps more on top of this might argue with me and say that the top income tax rate's 43.4% because of the Obamacare surtax, and I would have to concede that to you. And we'll talk about that in a second. But in any event, on the bare income tax rates, ignoring the Obamacare surtax, the president's proposing that we move to 3 brackets with a top rate of 33%. And then the capital gains brackets and brackets would change. The rates wouldn't necessarily change, but the brackets would change. Now, how does that look? Well, the 3 brackets are a 12% bracket, a 25% bracket, and a 33% bracket. And you can see from the chart here exactly where those brackets would hit. Furthermore, you can see how the capital gains rate matches up with the various income tax brackets. A couple of observations. First of all, the impact of the brackets will depend really on exactly how much taxable income your client and your prospect has. For some people, the amount of tax they end up paying might be lower. For others, it might be higher. So you've actually got to look at that and compare the income tax brackets to the current brackets to try to figure it out. The second thing is that the capital gains rate of 20% is going to hit at lower AGI rate or taxable income rates perhaps than it did in the past. And so for some of our taxpayers, the capital gains rate might actually be higher than it would be under current rules. So those are interesting things to kind of think about, I suppose, but obviously all of this will have to play out in some detail. What are the additional details associated with what Mr. Trump has proposed? He would eliminate head of household filing status. He would also eliminate the net investment income tax, the Obamacare 3.8% surtax on net investment income. That's particularly a boon to our higher net worth, higher income clients, and so that's a positive thing for us to potentially talk about. It would increase the standard deduction for individual taxpayers, increase them substantially. As a downside to that, the personal exemption would be eliminated. It would limit itemized deductions for high income taxpayers. I don't know whether that would be similar to the way that they're phased out now or whether it would be a different way. That's not clear from the proposal. One thing that is good that would reduce tax complexity is it would eliminate the individual alternative minimum tax. And so those are the details associated with the Trump proposal, such as they are. What are the opportunities for us when we talk to our personal clients or non-business owner clients? Well, I think for many of them who have high income, they would effectively have lower capital gains rates, and it would make it less costly tax-wise for those who are interested in transition from equities to more guaranteed products to make that commitment. So I'll give you that for whatever it's worth. A lower personal income tax rate might encourage Roth conversions for certain taxpayers, and so you may want to start visiting with those folks who perhaps talked about doing Roth conversions in the past so that they're alert to what the Trump income tax changes might be. And I think there's a direct link to permanent life insurance. Parking some money in permanent life insurance or perhaps a deferred annuity so that there is an automatic hedge against inevitable future income tax increases. You know, if the Trump administration gets its way and effectively lowers income taxes for some of our clients and prospects, inevitably in the future those rates will increase. And so the value of life insurance or annuities as tax-deferred and tax-advantaged vehicles to save money and perhaps draw into later on will be increased. And so I think it's an opportunity to talk about that with some of our clients and prospects. For our business owner clients, Mr. Trump has floated the idea of reducing the corporate income tax rate from the current maximum 35% to 15%. Now what's not clear is whether or not the new rates would apply to pass-through businesses like proprietorships or partnerships or S corporations. It's not clear whether those tax rates will stay personal or whether there'll be some relief for them down to a 15% rate. Also, he's proposed eliminating the corporate alternative minimum tax, which has the potential to affect certain kinds of C corporations in some years. That's a less big change than it is on the personal side, but it still can be significant for a company that is affected by it. So what are the opportunities for you as you talk to your business owner clients about these possible changes? Well, I think it seems like 2017 might be a better tax year for companies to recognize income than 2016, the one that's just passed. And so if there's any opportunity to reduce 2016 taxes, those strategies ought to be thought about. The most obvious choice is for a business to consider implementing a SEP for 2016, because you can still do that up till the due date for the return for 2016 and get a deduction for last year. And so that ought to be thought about. If Trump's corporate income tax changes become reality, they will probably positively impact C corporations. And so for your client who is an entrepreneur who doesn't yet have a C corporation in the client's mix of companies, that ought to be thought about. Perhaps getting the client to create a C corporation and figure out how to flow some money through it might be something that would allow the client to save taxes in the long term. That ought to be thought about, and perhaps you want to get the client's CPA to be an ally in that consideration. Even if even if the Trump administration is able to make no changes to the tax code, adding a C corporation to a profitable entrepreneur's stable of companies is an idea that worked last year and would still work even if there are no changes to tax brackets. And so it's something that ought to be considered and something that you can talk to your business owner clients and prospects about now. Let's shift focus and talk about what the Trump administration has discussed with regard to estate taxes. So the Trump administration wants to eliminate federal estate taxes. Just as a review, we've currently got about a $5.5 million federal estate tax exemption in 2017 with an estate tax rate of 40% on everything that is in excess of the exemption amount when wealth gets passed to the next generation. The current rule is portability, which means that a married couple, if both spouses are citizens, can shelter nearly $11 million of wealth from estate taxes. And Trump's proposal would eliminate federal estate taxes entirely. That's the good news. The bad news is that step-up in basis at death would at least change and perhaps be eliminated. It's not clear because the Trump candidate proposals on this were lacking in detail. It's unclear whether step-up in basis at death would be eliminated completely or whether it would be eliminated on assets over a certain threshold, for example, $10 million. And what's also unclear is whether it would just be an elimination of step-up in basis or whether there would actually be a mark-to-market capital gains tax at death, basically a capital gains tax on all unrealized appreciation in capital assets that the heirs would have to pay. I know that that's a big hole over the timing of the income tax result, but we just don't know what the proposal entails. And commentators that I've seen write about this are not consistent with what they think the Trump proposal means. And so we'll have to wait to see how that gets sorted out. So what are the opportunities with regard to repeal of estate taxes and a change in the capital gains treatment at death? If there is a mark-to-market at death and that the heirs of an estate will be required to pay capital gains at death, it still underscores the need for life insurance and the tax-free life insurance benefit. The family's got access to that. They've got access to money to help offset the capital gains tax liability. And then the second opportunity is that as you're meeting with your high net worth clients, they ought to think about the shape of their estate plan and think about whether or not their estate plan is going to conform, their current estate plan is going to conform to the most efficient way to pass wealth to the next generation, whatever that is. And so you might ought to start those conversations with your clients so they get ready to go visit with their estate planning attorney when whatever change might happen actually does happen. Let's touch briefly on the Department of Labor fiduciary rule. In the spring of 2016, as almost all of us are likely familiar, the Department of Labor issued a set of rules defining who's a fiduciary for the purpose of giving advice with regard to certain kinds of financial services, including IRA rollovers. While the rule became effective last year, it's being phased in. It's due to be partly effective on April 10th with a final phase-in at the beginning of next year. The Trump administration has sent all kinds of signals on this. It is possible that the effective date will be delayed. It is possible that the rule will be repealed in its entirety, or some kind of modification might be possible. We just don't No, we don't have any details yet. We've seen some recent speculation that seems to indicate that the administration is leaning toward delaying the implementation date from April 10th to sometime later, but that's not carved in stone yet either. So in the face of that, what do we do? What are the opportunities? Well, it's possible that the April 10th date is still the operative date, and so our carriers and ourselves may look at that as really being a fire sale on IRA rollovers. I put that there in the first bullet mostly as a joke. I mean, the fire is only at our end, not at the client's end, and so there's nothing compelling from the client's point of view to do a rollover by our deadline. I think the other two bullets are worth mentioning. They're fairly obvious. A repeal of the DOL fiduciary rule would allow us to do business as usual and without having the burden of conforming to new and significant federal oversight. But if there's no repeal, that means that clients are going to have to sign new engagement agreements with us if we're going to continue to talk to them about the possibility of rollovers. We've got new paperwork that we have to deal with, but the clients have to deal with it, and so that's an opportunity to visit with them, talk over what the new rule means to them, and anytime we have an opportunity to get with our clients and talk about the federal government, perhaps commiserate about the federal government, that's really kind of an opportunity for all of us. So I'll give you that for whatever it's worth. So I close this session with one of my favorite quotes from Gandhi. I don't know exactly what this might mean in this context, but I think embracing change and leading change are both incorporated in this idea. And so I think with change comes opportunity for all of us. And so I think, as we kind of struggle with anxiety over what might happen, I think it's fair for all of us to recognize that change does bring opportunity. Now, we talked specifically about the Trump proposals on income tax simplification, estate tax elimination, and their ambiguous approach to the DOL rule. We discussed how life insurance might help hedge against future income tax increases, how life insurance can still be used as a tool to manage post-death income tax liabilities that might exist instead of the estate tax in the future. We also briefly discussed how the DOL rule, if it happens, still provides a reason to visit with our clients. Look, change is inevitable, even to what we discussed today. So embrace change. Use it as a reason to visit and serve your clients. And I would like to thank you all for attending today. And Lisa, please wrap this up for our attendees.
Will do. Thank you, Linus, and thank you all for joining us today. As a reminder, if you'd like to receive supporting materials, feel free to email us at asktheexpert@advancedunderwriting.com, and you may also email questions related to today's webinar. Finally, for more information about the services that we at Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. Thanks again, and best wishes for continued success.